Yeah, thanks.
All right, we'll get started. Thanks for joining us here today. We have a pretty intimate crowd here at Hamilton Arts Inc., but I'm also happy that we're welcoming, what do we have, 5 people right now through Facebook Live, so hi everyone on Facebook as well. I'm going to introduce our speaker here today that's going to be presenting financial advice for artists and creative makers. Sunny is going to allow some time during the presentation to ask questions, and then we have Jasmine Mander, who's our communications and outreach coordinator, is going to be moderating questions that come through Facebook Live. So if you do have questions, type them in, and when we have time during the presentation, Jasmine will try to get those questions in for you. So I'm just going to welcome up Sunny Widerman to be our facilitator today. She's been a tax preparer and advisor since 2002 with a growing clientele of freelancers, business owners, and professionals. Through her firm, Personal Tax Advisors, Sunny specializes in helping clients take control of their tax planning by explaining the tax issues that affect them. She focuses on a gentle, non-threatening approach to financial issues and clear, jargon-free language. So welcome on up, Sunny. Thanks for joining us.
Crowd, the roar of the very intimate crowd. Hello, Facebook. Okay, so we're going to talk a little bit about income taxes on a Saturday morning during a pandemic. So it's pretty much the best of all possible worlds. So first things up, who am I and why me? As was mentioned in that lovely introduction, I have been doing income taxes for self-employed people really since about 2002. I created my own firm in 2005, and I've been doing this ever since. I have prepared over 1,000 tax returns. My team has prepared close to maybe another 500, 700. We're working on getting them up to where I was. And most of those people that I have done taxes for have been self-employed, and most of those people have been in the creative fields. And that includes musicians, writers, a lot of people in film and television, and visual artists as well. Can I just get a quick idea of like who is here? How many people here would say that they are visual artists as opposed to, okay? Any musicians, okay? Writers? All right, so we're talking, okay, a little bit of writing, there's often a bit of crossover because creativity is kind of like that. It doesn't really recognize the bounds so much. But okay, so we're talking about a lot of visual arts here, and that's good to know. I do want to talk a little bit about why it's important, if you feel, why am I here on a Saturday morning when I could be at home? Why am I streaming this when I could be at brunch? And why it matters. And why it matters is that income taxes are going to be part of your self-employment life. It's always going to be important. You're not going to be able to get away from that. And yet most of the people who get into the creative fields don't get into it because they love doing financial things. It's, of course, usually the complete opposite. So people will tend to sort of neglect this side, which I totally get. And the problem is that if you completely neglect it, there are consequences. And to pay enough attention to have no consequences is not that hard. So we're going to make sure that we cover everything here that will keep you guys out of trouble for your entire working lives, just with a little bit of this sort of like slight inoculation of a couple of hours on Saturday morning. So to give you an example of somebody who unfortunately did not get this kind of exposure early in their career, we got a phone call, this was like last fall, I think, from a person. She was actually an actor, and she had been an actor, not making a whole lot of money, but an actor for the last, for her whole career, and she hadn't filed her taxes in 10 years, which happens. We get lots of people who are cleaning things up. Okay. But the thing is that the Canada Revenue Agency wanted those taxes. They had sent her many letters. They were really wanted those returns, and she hadn't filed them. And so they'll file something for you if you don't file. And then they want the money. And she ignored those letters because it gets harder and harder, right? So what will happen next is that the Canada Revenue Agency will garnish you. And a garnishee, as a lot of us know, is when the government sort of gets between you and your pay. They just say, okay, they'll say, you know, before you get paid by your employer, we're gonna take a cut of that, you know? And this is terrible. It stinks because you're working and you're not getting all your money. And the other aspect of it that a lot of people kind of don't really think about is that in order to do that, to get between you and your money, they have to go to your employer and tell on you. Like they'll say, you know, she's in trouble, we're taking some of her money. So it's kind of mortifying, you know, in addition to everything else. We do have a little group here, so I'll take a little poll. Does anybody have any idea how much CRA will garnish you in this situation? Like how much, what percentage of your earned income that they will take? Anybody just want to venture something just for liveliness?
30%.
You said 30, okay? 50, okay. It was 100%. It was 100%. So every dollar that she legally earned would go straight to the government instead of to her. This is not good, okay? And this was really a way of getting her attention, and believe me, it did. So she calls us, and she wants to know, you know, can we do 10 years returns? Yes, we can. 10 years is not going to be a cheap job, because it just can't be. But we, you know, put together the quote, we gave her some discounts, we try to do that when people have a lot of years to clean up. We gave her the quote. It's still not a small quote. It's not possible to do 10 years for not a bit of money, which is tough because she's, of course, getting no money for what she works at right now. So to our complete lack of surprise, she did not respond. We sent the quote and heard, you know, crickets. But she did. Like a month later, she got back in touch and she said, I'm sorry, didn't respond to that last thing, but I got evicted. So here she is. She's been evicted. She has no legal way of making money. And here she is. This, I do promise a jargon-free experience. But in my industry, this is what we call an effing catastrophe. This is bad. This is life-changing bad, right? This is very, very bad. And what kills me about it is that for her to stay on top of things would not have been that hard. Not really, if she knew. So the whole point of this exercise is that we'll give you enough knowledge that this will never happen to you, that you understand the bare minimum of what you need to do to keep from the Canada Revenue Agency just taking the rug out from under you. Because believe me, it is not their primary, they don't really want to destroy your life. A destroyed person doesn't make money, and a person who doesn't make money doesn't pay taxes. They don't want to destroy your life. But they will if you just aren't playing ball at all. So we're going to teach you how to play ball, okay? And that's why I'm here. So let's talk a little bit about like what we're really talking today about is being self-employed, being a form of an entrepreneur. Artists sometimes do not like the word business, but if you want to make a living doing what you do, that is by definition now you're in business, okay? Just like a person who sells real estate or whatever, you're in business and you are self-employed. And self-employment is different and more complicated than being a salaried employee. And that's why, you know, you're watching this or you're attending this and you're not, you know, just waiting for your T4 to come in and taking it to H&R Block. Because there is more to know. And the reason there's more to know are because of these differences between self-employment and regular salaried work. So the number one thing is, of course, the ability to reduce your tax bill by writing off expenses. So we will be talking a lot about deductible expenses, about what the rules are, what you can and cannot do. Secondly, setting money aside for tax. When you have a salaried job, you know that they withhold tax from you at source. That tax that they withhold actually goes directly to the government under your name. And then when you file a tax return, it is taken into account when they decide how much you have to pay or whether you have to pay at all. When you're self-employed, nobody's withholding anything because basically you're just getting paid and then you're on your own. So you're responsible for, you know, setting aside tax, and you may not know how to do that. We'll talk about that too. Obviously, the GST or the HST is a big question that a lot of people have, a lot of questions about that system, which come into play. I'll say up front that I will use the terms GST and HST more or less interchangeably. It is one system. The only difference is like different provinces sort of either they're on the GST or the HST, but the basic system is identical So if I switch back and forth, don't take it too seriously, it's the same. You have special filing deadlines. Filing deadlines are really key because once again, we're talking about the Canada Revenue Agency and, going back to the story that I was telling you earlier, the bigger issue was that she hadn't filed returns. The paperwork is primary and the money, believe it or not, is secondary. First paper, then money. If you give them the paper, they know they can get the money. They're the government. If you don't give them paper, they don't know what to do. And so filing deadlines become very urgent. You need to keep better records because you are responsible for being able to sort of answer questions about your taxes for many years. And there are special rules about employment insurance. We may not get to this one because the EI system for self-employed people, it was only put into place maybe less than 10 years ago, and not a lot of people have taken advantage of it. And there's a really good reason for that, and that is it doesn't really do a lot for you, and it can be a bit of an onerous obligation. So it's not really great, particularly for people in the arts. We'll talk about it if people are interested in it, but it's not really, not likely to give you what you need. But it's there, it's different. So let's start with business deductions, which is central to handling your taxes and reducing them if possible. So what happens when you are self-employed, when you have a business, is you take your gross, which is all the money that you collected for your work, you subtract out your business expenses or your deductions, and you end up with a net profit, hopefully. You are taxed on the net profit. So you're not taxed on what you're paid, you're taxed on what's left after you write off your expenses. So this is really key because this gap between what you made and what you expensed, right? This is what you get taxed on. Obviously, for tax purposes, you're trying to keep that gap as small as possible. But in terms of like living your life, you want to keep it as big as possible. So because you want to live on it. So there's sort of two forces here happening. But we're talking about taxes, so let's talk about bringing it down. One nice thing is if you have business expenses that are actually kind of personal expenses, so things that you were kind of spending money on anyway, that now become business expenses because you are now self-employed, you get to write off a bit of that. So now you're not really spending extra money, but you are reducing your taxes with the same expense. So your computer, possibly your vehicle, and your home if you have a home office. And then there are certain rules about certain kinds of expenses, like meals and entertainment have a certain rule, and capital assets have certain rules. But almost everything basically is just go for it, kind of. They're all treated the same way. But, and it's not like every possible business deduction has been categorized by the Canada Revenue Agency. Rather, every business is different, and every business has a different set of expenses that is tailored to what you do. And certainly as creatives, each one of you does something completely different from the next one. That's kind of the definition of what you're doing. So there aren't a lot of rules about it, except there is an underlying principle that you will apply when you are writing something off or debating writing something off that you're not really sure is legit. And the key is the reasonable expectation of profit. This is, as far as 4-word sentences go, or even 3.5, this is sort of like one where every word matters, right? Taxes is where the law meets accounting. So wording really matters here. So let's take these words in reverse order. Profit. Obviously, profit is collecting more money than you spent. So the expense has to be less than it's going to earn you. Expectation is that it doesn't actually have to happen that way. It maybe the expense is more than it earns you, but you have to have expected it to do so as a reasonable person. So you're, when you spend money on a new, like let's say you decide to expand your repertoire, you're gonna invest in a 3D printer, right? Because you think it's going to actually help your business here. You want to write off that cost; they're expensive, right? You have to expect that you're going to earn that money back through the use of your 3D printer. As a reasonable person, if you're I'm just trying to think, like, let's say you're a musician and you're like going to buy a 3D printer for your art. Obviously, they're not really related. It's unreasonable to expect that a $3,000 3D printer will help a musician make more money. But a visual artist who specializes in sculpture could definitely say, I'm a reasonable person, and I think this 3D printer is going to make me some money, right? So you don't have to prove that it works. You do have to prove two things. One, that whatever income you think you're going to make is greater than the cost of the cost. And finally, that belief is a reasonable belief. Apply this measure to all your business expenses that you intend to apply against your income for tax purposes. In fact, as a business person, right, you should be applying this logic all the time, right? In terms of, as a person who wants to not just do their art, but live on their art. The rules are different if you really don't care. If you've got all the money you need and you just do art because you like it, that's not really a business, right? But if you want, in addition to doing your art, you want to actually make a living at it, then all your business expenses have to be smaller than what you make, right? So every time you're thinking and you're looking at that laser printer, that 3D printer, you should be thinking about this. Like, how am I actually going to make this pay off? That should be in your mind anyway. And it's also good to have that in mind and to have some kind of, record of that in case the Canada Revenue Agency ever asks you the question. Do you have any questions before we go on? Okay. We're good? Okay, here we go. So the next issue is setting money aside for tax. Now, as mentioned, when you are not self-employed, when you're salaried, your employer tends to set some money aside, sends it to the government under your SIN, your social insurance number. When you do your taxes at the end of the year, what you're actually doing is, this is the first actual calculation of what you owe in tax. Nobody knows up till then. When they withhold money, they are doing it based on an estimate. CRA lays out what those estimates ought to be, your employer sets it aside, and then you do your income tax return. And at that point, you find out what you really owe. And if what you owe is less than what they've set aside, you have a tax bill. And if what you owe is, if what you owe is less than what they set aside, you get a refund. And if what you owe is greater than what they set aside, you have to pay out the difference. As self-employed people who are hopefully earning some money from which no one is holding back anything for taxes, you should really have a tax bill at the end of the year. If you don't, it's because you're working a job where they over-withheld and ended up covering your self-employment income as well. But generally, you're going to assume that you're going to earn enough money that you're going to have to pay some tax. So, because income tax is based on the net, so your gross minus your expenses, an estimate is the best we're going to do because every business runs on a different profit margin. How much more do you earn, compared to what you spend? And because we can't know that at first glance, we cannot say, and because everybody's business is different, we can't say, here's what you should set aside. So instead, we do find, I'll go back here. We do find that most of our clients, for every dollar they actually invoice and receive, they end up having to pay 15 to 20% of that. It's actually, the average comes to around 18 in taxes. So what we tell them is set aside something between 15 and 20. Because if you set aside 20, you're in pretty good shape. If you even set aside 15, what you've set aside will be close enough to what you owe that it won't be a big deal. If you over set aside, then obviously you're going to have more money than you need. You're going to pay your taxes. You're going to take the excess and presumably drink it. Writers, we are visual artists here, so your expenses are a little higher. So I'll just give the example of writers because they are kind of the least expensive creative endeavor. They just don't have to pay for much. And so they bill their gross and they keep almost all of it because their expenses are so low. Consequently, they're taxed on a big chunk of their gross. And for that reason, they have to withhold more from themselves. So you've got to look at your own business and at first you're going to just have to guess based on, do you think that you're a kind of person who spends very little money, or are you all the stops are out, you're going to invest as much as you can into your business, and therefore sometimes your profit won't be that high. If your profits are low, you're going to withhold a little less. If your profit is high, you're going to withhold more. It also depends a little bit on your margin for stress, and which kind of stress bugs you more. Like living on less money because you've set so much aside, but you're pretty certain that you're never going to pay a tax bill. That's one kind of stress. Living easy during the year, but you probably will owe a tax bill at the end. Different kind of stress. So you kind of have to decide for yourself. So you can start with 20 or 25. Even 20 is great. You know, set aside 20% of everything you bill. You will probably be fine. And then if you're not fine, you'll up it. If you are fine, you can bring it down a little bit. Once people sort of have once you have a few years under your belt, the way that your business runs becomes sort of clear. You know, about 3 years, 3 years of sort of running it, it becomes clear what kind of business you're running and how much you tend to reinvest. And then your percentage, we can calculate that specifically. We can get pretty good at this because people are the way they are. Like, you know, if you're a big spender, you're a big spender all the time. If you're a low spender, you're a low spender all the time. This works pretty well. Now, where do you put it? No rude answers. Where do you put it? Well, number one, you know, the reason that you have a system where your employer sets money aside for you is because of the psychological fact here, which is that if you don't see it, you don't miss it. It's one of the toughest psychological things about being self-employed and managing your taxes is that it's twofold, really. One is that you can see the money that you're not supposed to spend, and it's hard, particularly if if your business is not making a lot of money, if you're living pretty tight anyway. It can be exceptionally difficult to sort of know that there's like $2,000 sitting there to see it and not be able to do anything with it, and yet you must. So put it where you don't usually see it. I'm a big fan of online banking because it's free and because those accounts are kind of a little bit more awkward to get to. You know, you can take whatever bank account you use for your daily, you know, transactions and have the money parked somewhere else, and you don't have to look at it all the time. You can just sort of ignore it, which psychologically is better, because I promise you that though it is definitely sometimes very hard to set aside money, particularly when you're not making a lot of it, it is harder to find it later, to find a year's worth of set aside money later when you file your taxes. So as hard as it is to sort of, you know, to take that glorious check that you've been waiting for and then like tear off 20% of it and put it somewhere, that's hard. But finding that 20% when you've already spent it, much, much harder. Much, much harder. Oh, by the way, I should have made this clear at the beginning. These slides are going to be available to anybody who wants to, I think that Hamilton Artist is going to take email addresses. I'll send you the deck. I also have a sort of a more detailed guide to business deductions, to what you can deduct and what the rules are. I did say that there are special rules for certain kinds of deductions. That's in there. And I also have a guide all about the GST, which we'll talk about in a little bit. So, you know, don't worry too much about the details here. We're just trying to get the idea here. And I would really rather that you're sort of able to pay attention and focus and not miss anything important than that you sort of, don't feel like you have to write everything down, because you'll have this. So you can just sort of, you know, enjoy it. Enjoy the tax time. Whatever. Okay. Alternatively, so this is so the first example that I was giving you was sort of like where you take your money that you earn and then you take a part of it and put it away in an online account. Another method that some people use is they take all the money and dump it into the online account and pay themselves a salary. The theory is still the same, that some is yours to spend and some is yours to hang on to until it's time to file. But that just depends on what system you prefer. Just as a little moment of tax trivia. You do this long enough, you end up knowing a lot of tax trivia. Has anybody ever heard of the window tax? Does anybody know what it is? Okay, so the window tax, income tax, the concept of income tax, of let's take a certain amount of money that people earn, let's take a certain amount of money that people earn and contribute toward a common wheel, you know. Income tax is a very old concept. It really was invented, like, I think a couple centuries ago. I should know this, but a while. Surprisingly, the people who would be taxed did not, and still don't, like to tell the government how much money they made in order to be taxed on it. they tended to avoid that. And in the days of, quills and paper and horses and stuff, it was very hard to get in there and find out. So an indirect way of trying to figure out how rich somebody was by looking at their house and seeing how many windows they had. I mean, because poor people just lived in there were no windows, but rich people, windows. So, and you'll see that there are like 4 windows here that are actually blocked up, and you'll sometimes see this, I'm told, in some older English manor houses, because what they would do is when they got word that the tax assessor was coming through, counting windows, and they're going to apply a tax to every window, they had these elaborate schemes for like hiding their windows and making them not windows, like, woo, not a window, and they would get away with not paying less tax by faking out that they didn't have windows. So, so if you're ever, looking at a really old house in the UK, and for some reason beautiful windows are just bricked up and they're not really windows, it might be a holdover from this era. And it also tells you, because that was a long time ago, that almost from the minute that income tax was invented, there was income tax evasion. Like immediately, nothing is new. Nothing is new. Okay. So a little bit about grants and royalties. Obviously, the Canadian arts scene is largely funded by grants. And I will say, by the way, I can see the screen that I'm on here on Facebook makes it very hard to see my teeny tiny button, which is my I Heart Taxes button. This is actually created by a client of mine who is a visual artist. She's awesome. And artists really have to heart taxes, because so much of the art world runs on grants, and the grant money comes from taxes. So let's talk a little bit about how you declare that on your income tax return. There is, I'll explain this slide. So we typically declare your grant income and your royalty income as part of your self-employment gross income, okay? Which puts it on one section of your tax return. The default, like if you're using software, or if you go and get your taxes done at a place that doesn't really know about this stuff, the default is actually to put it somewhere else. So they will put it on line 130 or line 121, which you don't need to know the deets about that, but we will put it on your business gross. The Canada Revenue Agency also expects to see it on those default lines of 130 or 121, and yet we're putting it somewhere else. Where we put it is legal. It's just not what they expect. And because it's not what they expect, we will get a call, we'll get a few calls every summer when what's called CRA matching, which is a department that looks at your return and looks at the tax slips associated to you and takes a quick gander to see if it looks like you reported everything. So what they see is they see this grant and they look at line 130 to see if it's there, and then they don't see it. And then they say to our client, where is it? The client comes to us and goes, where is it? And we go, it's cool. It's on their business gross. So putting it where we put it invites this sort of back and forth. I mean, the client gets a little bit worried. It doesn't happen very often, but each client gets hit with it once. They're scared, and we have to do some work. We now have to make a call to CRA. Like, it's work for us, and it's stress for them. So why do we do that? The reason we do it, there's a number of reasons why we do it. So one is that a lot of the grants, in fact, almost all the grants that you're going to get from the arts councils are meant to fund a project, right? You submit a budget of what it's going to cost to do this thing. They give you the money to cover that, which means that if everything goes to plan, they'll give you a $5,000 grant and you will spend the $5,000, and there's no net profit for you, and therefore no tax. If you report your grant in the default position of line 130, you get to deduct $500 flat, and that's it. So now you're paying tax on a bunch of money that you didn't keep because you were actually fulfilling the purpose of the grant. If you put it as business gross, you can write off all the expenses you want, because that's how that works. So in order to make sure that you don't get taxed on money that essentially you did not keep, we put it on as part of your business gross. It's more accurate, right? Let's say let's say you get a good solid grant, $15,000 grant, and that's the extent of your business that year, that you just spend the whole year, right? So if you reported on line 130, you end up reporting 14,500 and just paying tax on that. If you report it as business gross, you end up with a net of maybe nothing, because you spent the money you said you were going to spend, and you pay no tax. So we really don't want it on line 130. It's too restrictive for a project grant in particular. Another thing about grants is that you'll frequently get a grant that is meant to span a project that itself is going to take 2 years or more. Often the Canada Arts Council will sometimes in their paperwork give you the option to get the money in 2 parts. If it's a 2-year grant or 2-year project, to get it in 2 parts, that's usually it's better. It's a little more accurate. But assuming that you didn't check that off, or assuming that you really don't know when you're going to spend all the money, that maybe all the expenses are up front, though the project takes 2 years, or for whatever reason, you take 2 years worth of grant money in a single year. And at the end of the year, you're only partway through the project. You haven't spent it all because you haven't done it all. You can deduct the excess as a reserve and declare it in your income in the next year. And that's a property of the we refer to the T2125, which is the document inside your taxes that calculates your profit and loss from your business. So we can deduct that there, and then it comes back in the following year. Again, legal, intended to be used this way, but not possible on the default line of 130. That doesn't work. There's no reserves there. So again, to reflect the reality of your grant, a lot of times, let's say you don't know how much of the grant you're going to do, you get a $10,000 grant. By the end of the year, you've done about 60% of it, but you're not done yet, and you know that 40% of the expenses are still to come. We would deduct the $4,000 as a reserve this year. Next year, we declare that $4,000 as income. So it's a way of sort of splitting it the way it was intended to be split. Okay? That is possible if you make it into your business gross. It is not possible if you leave it on line 130. And finally, grants and royalties subject to CPP. So royalties, weirdly, are actually considered to be a form of investment income. If you make your royalties, no musicians here, but any musicians out there, if you're making your royalties through SOCAN or any of the other, there's literary rights and there's all kinds of different kinds of royalties, they will sometimes issue you a tax slip, like a T4 or something, but it's a T5, which if you look closely is actually the same form you get from your bank to declare that you have interest. All of these are considered investment income because of the concept that you invested earlier and now you're just sort of like raking in the cash. So a royalty can be seen as investment income, and by default it is seen as investment income. And it would show up on the same line where you declare your bank interest. That is the default. The problem is that you don't pay into the Canada pension plan on money that's through your investment. Now, we're talking about paying, and I'm talking about you want to pay more, right? The reason you want to pay more is because the pension that you're able to collect when you're of age to collect it actually is related to how much you paid in during your working life. So you really do want to pay into that. You want to reduce your taxes if you can, but you want to max out your CPP if you can, because it will matter later, particularly if you're self-employed and you don't have, you don't have a pension coming to you. CPP becomes massively important. So that is your pension plan. It's all you got. So you definitely want to pay into it if you can. So we definitely, the reason that when it's considered investment income, it's not pensionable because that's not earned income, just to say, it's not money that you, theoretically, that you worked for, even though you did. But if that royalty is part of your arts business, it really is part of your working income, and so it is covered by the pension plan, whose purpose is to replace your earned income when you're no longer earning. So these are the reasons that I like to have it there. A quick digression, if you do any work for US clients, which does happen, a lot being that we live beside the beast, all that income does have to be declared on your Canadian tax return, obviously converted to Canadian dollars. We will talk about the GST, but if you are registered for the GST, you do not collect it from non-Canadian payers, so not Americans, not Europeans, not anybody. And they may ask you for a W-8 BEN. A W-8 BEN is an IRS form. It's not that hard to fill out. It basically says, here I am and I am Canadian. And all that really means is that it gives the American payer the right to not withhold American taxes for you, which is what you want. It's too much to go into right now, but you end up paying more tax. If they tax you and then you get a little bit of a tax break on the Canadian side, but the break isn't as big as the taxes. So you want to try to avoid paying foreign taxes if you can, because it's just not a great deal. The W-8 Ben will allow you to avoid paying tax on American income. Not everybody will ask you for this or have it as an option, but if they do, go ahead and do it. The form may look a little bit intimidating at first, but if you look really closely, you'll find it's not that complicated to complete it and just say, you know, this is who I am and I'm Canadian. So do the W-8 Ben so that they don't withhold tax. Tax trivia. Until 2020, actually until February 2020, married women on the British Isle of Jersey needed to have what in order to discuss their tax situation with the government? I'm not even going to ask. Written permission from their husbands. Until 2020. I can't even. I don't know, so presumably she's looking in her purse for written permission from her hubby. So they just lifted that. I'm told that the Isles of Britain are weird. Okay. Okay. Do we have any questions before we move on to the large topic of the GST and the HST? Anything? We're good? Okay. Hi, Facebook. If you have questions, I can't hear you. Okay. GST and HST. Always a question of interest. Is anybody here registered to collect it? Okay, yeah, all right. But you'll all sort of know about it and possibly fear it. I'm going to take that fear away. The GST-HST system is actually one of the simplest, conceptually, the simplest systems in the tax world. With the GST, you charge this amount on top of your fees. And that amount that you've charged does not belong to you, it belongs to the government, flat out. Meanwhile, when you are spending money on your business investments, for example, on a 3D printer, the GST or HST that you spend on that asset, you can have it back. So the money, you collect money on top of your income that doesn't belong to you, but then that expense that you would have spent anyway, you get back. And because of this, financially speaking, mathematically, you're always at an advantage to be registered for the HST or GST. Always, always. Because the money that you're giving to the government, you collected on top of your fees anyway, and the money that you're taking back, you would have spent anyway, and it just would have been gone. Now you get it back. So there is no way to be left underwater by the GST system. There is no way to have to give the government more than you collected, because that's exactly what the calculation is. How much did you collect? Subtracting out what are we getting back? There's no way. The way that people get into trouble is they collect the GST or the HST and then they don't set it aside in that fancy online bank account where you're keeping all the money that's not yours, right? The only way to get into trouble is to mismanage it, is to not keep it aside, is to forget that it's not yours. But if you don't forget that it's not yours, and you just set it aside and ignore it, you'll be fine. Hiding your income level. So, you know, in Canada, most of us know, if we know one thing about the GST, it is that you don't have to register until you hit $30,000 in gross. Or a lot of people know that. And so if you, once you're registered for the GST, you actually have to put your GST number on all your invoices. You have to show the amount, show your number. And therefore, you can see instantly when you look at an invoice whether the person is registered or not, which means that everybody who looks at your invoices knows right away that you are not making $30,000. Now, in a lot of fields, it does not matter. In some fields, maybe if you're trying to negotiate for a fee, it might be a little harder to do that when they know that you don't make that much money, right? If you're trying to front a little bit and you know, strut in there like you can take them or leave them, which is the way you want to be in negotiations, well, they'll know you can't really take them or leave them because you don't even make $30,000. So, then there's just the issue of privacy, where you just don't think it's any of their business. So if either of these apply to you, whether you think that it's going to be to your disadvantage or you just don't want people, frankly, to know your business, getting a GST number will hide that from anybody because nobody can tell that. And like I said, you get to keep it. You actually do a little bit better financially. But now you have this additional administrative burden, which a lot of people hate. And again, people don't go into the creative arts because they love administrative burdens, generally. But it is so straightforward. I'll tell you that when we do taxes for our clients, if they are registered for the HST, we don't actually charge to do it. It's like, we can't, when you're registered, we kind of can't properly do your income taxes without calculating this anyway, so we just do it. So it's not, to us, it's not a big deal, but, you know, obviously, we're in our field because we're cool with administrative burdens. So it's up to you whether you decide that financially it's worth it to you for the extra work to save that money, or, you know, for the extra work to hide your income from potential payers. It's up to you, until you make the 30,000. I do, as I mentioned before, have a 10-page primer on this. 10 pages, and some of those are charts, so it's really not a very big document at all. If you compare that to what CRA's documentation is, you know, they release tomes. The reason it's only 10 pages, and it will cover pretty much everything you ever need to know, is because the GST system can be large for certain kinds of industries, and all the CRA materials kind of cover every possibility. We just strip out the ones that we know are not going to apply to you. Like if you're not importing car parts from another province which has a different HST system, like that's not going to come up. So we don't have that section in ours. So the 10 pages is all you're ever going to need to know, because like I said, it's a simple system. If you you know, supply your your email address, I'll get that out to you, and you'll be able to just sort of have it on hand. The key here now is, when do you register? So 30,000 is the threshold. It's $30,000 in any 12-month period. It is not a calendar year. So if you suddenly get a boost of income, so you make $30,000, but the first half is in December and the second half is in January, so they're split by the year, doesn't matter. That is all within the same 12-month period. Okay, splitting by the year doesn't matter. You are responsible for noticing that. Obviously, when you're just billing people, nobody can see, like the government can't see that transaction happening, they don't know. And they won't, so there's no warning, there's no, you know, phone call or anything telling you that you need to do it. And even after you file your taxes, let's say you don't register, you just don't feel like it, and then you file a tax return that clearly shows that you made more than 30,000, you still won't necessarily hear right away. Nobody will warn you. But you will hear. If you cross a $30,000 threshold and you have not registered, Canada Revenue Agency will notice. It might take a year or 2 or 3, but they'll notice. And what they'll do is they will register you for you. They will back register you and say, well, we noticed that you made $30,000 2 years ago. We would like 13% of that now. And that is bad, because you're not going to be able to collect it from your payers, which is what you would have done if you were registered, you would have collected it. And now it's just your problem. So that stinks. You really don't want that to happen. You know, when we do tax returns, the most common question that we get is, when people are going through their business expenses or their business calculations, is out like, will this deduction get me a red flag? Is this deduction gonna, you know, make CRA mad? Are they gonna? Audits are super rare, and CRA doesn't see a lot of detail in your tax returns. You know, these things that people are afraid of don't happen all that often. They happen, but not that often. But getting caught because you didn't give them a 5-minute phone call and say you crossed the $30,000 mark, can I get a GST number? Which is all it takes. Phone call, tell them who you are, give your SIN number, say you want one. They'll ask you a couple of questions. 5 minutes later, you have a GST number, you're registered. Not doing that will cost you the 13%, right, retroactively. This is one of those areas where just not knowing about it is going to get you in trouble, and knowing about it is not a big deal, right? So getting caught later, super common, so don't let that happen to you. A little bit of tax trivia. What tax was imposed by Henry VIII, Elizabeth I, Peter I? They didn't have a whole lot in common other than being numbered. Well, I'll give you a hint. Well, because I'll just tell you. They taxed beards. They taxed your right to have one for various reasons. Either because, you know, beards are the province of kings, you don't deserve it. Or I was told by actually a participant in one of my talks that the reason that Peter of Russia imposed the beard tax is because he wanted Russia to be more westernized, and he saw beards as being kind of old-fashioned and backwards. So if you wanted to not westernize, you were going to have to pay for the privilege. So what you would do is you would pay a tax, and you would, hello, you would not, there you go. This is your beard token. There's like a picture of a beard there. And you carry that about in case the assessor sort of saw you with a beard and said, hey, buddy, did you pay for that? And you could like bring out your little thing, and then you'd go on your way. I don't know if you got charged extra if your beard formed a Dutch landscape, but you know, I would kind of think like if you're going to pay for it, you might as well go for it. With the beard. Okay, before we go on, because we just talked a lot about the HST. Does anybody have any questions about that? It's a big one. Okay, cool. Filing on time. So I said at the beginning of this talk that deadlines are super important, and the Canada Revenue Agency and Canada Revenue Agency agents. Canada Revenue Agency agents are bureaucrats, which is a good thing. We tend to think of the aspect of bureaucracy that we think about is paperwork and check boxes and everything has to be done a certain way or else it all falls apart. But if you step back a second and look at why that is, the reason that is because it means that there are procedures that apply to everybody. You do a set of things, everybody has to do them, or else it doesn't work, right? Having all those steps and having them codified is what prevents an agent from having enough power to do something for you just because they like you, or because they want to date you, or whatever, right? You can't charm them because they don't have the power. They can't do anything for you until you file this form. And everybody has to file it, whatever. This has a couple of consequences. I'll come back to this in a sec. Okay, I won't, I guess I'll hold it up there, but I'm not going to talk about it yet. The consequence is that paper becomes their driving force, right? A CRA agent is not working on commission. They don't care about your money as much. They care about the paper, because that is what they line their nests with. And they really, really hate it if, there's a slot, it's supposed to have a document in it, it's supposed to tell you something, and the slot is empty. That's worse than having a document in there that says something bad, is the emptiness. It's like staring into Nietzsche's void. They hate it. So they tend to freak a little bit. And that's why deadlines are so important. Because at the day after the deadline, they're looking at that slot and going, but there's nothing. I understand nothing. And it makes them very tense. Don't make a bureaucrat tense. Now, self-employed people, because your taxes are more complicated, you do get a little bit of a break on this. You actually don't have to file on April 30th like everybody else. You file on June 15th. And so does your partner, common law or married, which is a handy thing if you're trying to charm somebody, like at a bar or something. Like, dude, get with me. 6 more weeks, yo. Anyhow, so yeah, a lot of people don't know this, but you have until June 15th to file your return. But do file your return, even if you think you can't pay. So there will come a time sometimes when you made a bunch of money, but hey, you needed that money because you were struggling for 3 years, and so you just got new shoes and new teeth and new hair, and it's gone. And you know that you're going to have to pay tax on it, and you know that you don't have it, right? So there's the reflex thing to do is not file a return, because then CRA won't be mad, and they won't send you a letter saying they want the money and everything is fine, but that is not the case at all. Get the return in. I will say again, CRA agents do not work on commission. They don't care nearly as much about the money as they do about the paperwork. And that is evidenced by the fact that there are separate issues here. Like if you pay late, they want some interest. Because accountants look at money as the sooner you have it, the sooner you can invest it to make more money. The later you have it, you've lost an opportunity to invest. And that's what interest really is covering them, right? So they could have had your money a little bit earlier, they would have been able to invest it, they couldn't, and so you're going to cover the extra. It's not punitive, it's just math. Interest to them is just math. The penalty is punitive. The penalty is a punishment. It's random money that they're just going to punish you with. They just want it. And the penalty is for filing the paperwork late. The interest is for paying late. And late penalties are much higher than interest. So this is really key here, that, like, if you doubt me that they care more about the paperwork being in on time than about the money, just look at the numbers. The penalty for filing late starts at 5%, can go all the way to 50% of your tax bill, because you've got the paperwork in late, while the late payment is 0.5% per month or so. But now it has no real limit, but like you can gather it, in that much time. Mathematically speaking, making them wait 1 day for the return is as expensive as making them wait a year for the money. So file the return on time, and then take your year, right? Or less. Take less than a year if you possibly can. But this is the thing where your reflex is, if I don't file, I'm not in trouble. Once I file, I get a bill, I'm in trouble. It's exactly the opposite. So fight your instincts here. If you can't pay your tax bill, get that return in time, and then just handle the bill like you do any other bill. It's not changing. You owe the tax anyway. But giving them the paperwork to say so will make them happier, and will make you happier too in the end. Any questions about this? Okay. Keeping your records. So, being self-employed means having a lot more power over your taxes, because you actually are making decisions. Is this a business expense or is that? Am I going to declare this? How am I going to handle this? There are certain decisions you can make even within the things that you've decided to write off as to how you're going to write them off. Because of that, your returns are actually a little bit more prone to audit. Because if a person has just a regular job and a T4 slip, essentially the T4 slip almost is their return. They can't change it. CRA has a copy of it. There's not much they can really do, and so there's nothing for the CRA to really review there. There's nothing to audit there. But a self-employed person has so many choices that they absolutely can be audited, and an audit being where the CRA says, well, how did you come up with this? Like, where, can you prove that you really spent this, right? As a self-employed person, you're always going to be a bit more prone to audit. So you are responsible for keeping records that will prove your case for 7 years after you file a return. So it's not 7 years after the year, because let's say that you're 5 years late with filing a return, right? That doesn't mean that now you only have to hold on to it for 2 years, or you file 7 years late, so now you can burn all your receipts. No, the clock basically starts ticking when you file a return. So now you've got 7 years. Consider making copies of things like thermal receipts. So, okay, I'm going to come back to this in a sec. Basically what you want in your records is that whatever you have said in your tax return, you can back up and prove with your paper that you have kept for 7 years. Thermal receipts, if you've ever put one in your pocket or your wallet or almost anywhere, those are the ones that are printed on the shiny paper, and they're not really printed with ink, they're actually printed with heat. The kind that you get, well, now almost everywhere. They fade. You've probably seen them. They go from black to blue to yellow, and then they're gone. They're just a blank piece of paper. If you've ever taken one out of your pocket and found that it has already really degraded, you know that it's not going to last 7 years. So if it's an important one, make a photocopy. Take all the thermals and just copy them all, because a photocopy won't fade. Technically, receipts must include the address and the date to be valid.
So if you scan them and then you have a digital copy and then you can...
Yeah, it's probably just fine. Yeah. When it comes to record keeping, there are a lot of sort of arcane rules about it that nobody really observes. Like there can be weird rules about like resolution and stuff with the scan, but the reality is, it's fine. It's fine. You just don't want to hand them a blank, shiny strip and say, this was totally $300. It's not going to have any meaning to them at all. And the other thing is that in smaller establishments that are using like the older cash register, sometimes it just has the date, like it's just got a number and a date. If it's an important receipt to you, write down like where you bought it, so you can look up the address if you need to. In these kinds of rules, in a second, In these kinds of rules, I will say that these are the rules. They're not necessarily what would happen in a real audit. You know, CRA could be more flexible than their rules allow. It just means that they don't have to accept a receipt if it doesn't include the address. Yes?
What about MasterCard statements or Visa?
Oh, I put this in the wrong place. Hold on, I'll come back to this. Credit card statements are not receipts because they don't have the date and the address on them. Which is, it's unfortunate because they're so convenient. And I really recommend them. I really recommend credit card statements as a way of organizing your own thoughts on it. However, in the case of an audit, you need the cash register receipt. So you have to keep them both. You just, keep them. We will, I promise we're going to come back to the breast tax. It's a good one. If you don't have receipts, so as I say, now we're getting into the territory where they don't have to accept this, but they prefer a logical, reasonable, and written down, they love paper, estimate of something than nothing, right? If you're just going to say a number, that's not going to work. But if you actually have a note that says, oh, it looks like I spent this, like handwritten, your own note, they're more likely to accept that than you just telling them something. Yes?
Can you actually go back to stores and get them to print receipts?
I think it depends on the store.
Yeah.
Banks are better, right? Banks have a legal obligation to keep everything for 7 years. So in a way, like if you do things on debit, you're in a better shape a little bit. Like it still doesn't have the address, so it's still got the same problem as a credit card statement. But at least there is a record. If you do an e-transfer, those are good. Checks, those are good. Things that are tracked through the bank has to hold everything for 7 years for exactly this reason. So that's fine. But yeah, if you, yeah, oh, I think that's my phone. Okay. Pause while I turn that off. Sorry. How unprofessional. Hey, before we continue here, let's talk a little bit about the breast tax. Has anybody even heard of this thing? My trivia is rewarding in that I've never heard of anybody knowing the answers to any of these. It's awesome. I'll just keep this in my pocket. The breast tax, it was a fun tax. It existed around 1800 in India, and yeah. It was a tax that only women had to pay for the right to cover their breasts. So it was applied usually against lowercase women. It's obvious, nonsense taxes like this are always applied against the least powerful. So lowercase, poor women, if they wanted the right to cover up, they would have to pay for that. It's like Girls Gone Wild, but kind of awful, like even more awful, like codified. And the better looking the breasts, I guess from the outside, the better looking the breasts, the more they pay to keep them covered, which is, where do you even go with that? It does not exist anymore. And the reason it doesn't exist is gruesome. An angry woman severed her breast and said, take it then, as like her tax. She bled to death, but the tax was repealed the next day because that was the end of that. However, it was repealed in 1840, so it was around for a long time. A long time. Fun. Oh, okay, where were we here? Yeah. Car logs. So, if you are using your car for both business and professional purposes, you are supposed to be keeping a log of every kilometer you put on that car for business purposes. The way that we calculate business use of your car is you take the full cost of running your car. So all the fuel, all the oil, all the washes, all the maintenance, all the insurance, and you get a big number. And then you find out how many of your year's kilometers were for your business, and you use that to calculate a percentage, and then that's what you write off. So in theory, everybody's supposed to keep a log. I know that in reality, not everybody does. But the more you want to write off, the higher you want that percentage to be for your tax purposes, the more important the log becomes, because it gets more and more likely that an auditor is going to want to see where you came up with that. So we have a lot of people who will just sort of come in and just like throw a number at us. Well, I used it, but say 7%, say 10%, say. Okay, I'm your tax preparer. I am not the one who's going to have to defend this number. And if the number is small enough, CRA will probably never review it, and again, you won't really have to defend it. But if you're getting into the 20-25% range that you want to write off your car, you need some kind of proof. They will ask for that. And a handwritten log, again, it's bizarre. A handwritten log will suffice. No log, no good. You wrote a note, fine. I don't understand, but it's true. Particularly if, if let's say you had a few, like, let's say that your car use for business work was sort of confined to a couple of large trips. So you know that you did a road trip to do sketches of the East Coast. You know that you put, 5,000 kilometers on your car during that road trip. Write that down, when you were gone, what you did, some kind of proof that you went. That will work better than just sort of saying, well, I figure about 10%. They don't like that. Any questions before you move on? Yes?
What about like transit expenses?
Transit is a little bit easier to say, like, this ticket or this Presto team, this was for that job, right? It's a little bit easier. It's a bit of a pain to keep all your Presto stuff. It would be easier to just sort of like make a note of every day that you have to get on public transit to do the job, because like it's, what is it, like $3 or something, $3, okay, this round trip, $6. $6 this day because I went. Again, this is a note, right? If you sort of can prove, like, well, I had a thing, here I am. I had a thing, there's all kinds of records that I was coming here today. I would be able to take, if I want to, take my Presto card and say, see, it takes me $20 to get to and from Hamilton from Toronto. $20. The fact that I've got lots of evidence will trump the fact that I don't really have a receipt. I had to get here somehow, right? But the problem with a car is, because insurance, how much of your insurance covered that business trip? How much of the repair covered that business trip? Unless you start with an empty tank, fill it, finish the trip with an empty tank again, how much of your gas was actually, instead of trying to isolate the cost for each trip with a car, you use the percentage form. But with public transit or in cabs, it's actually much easier. I can literally, pull out a receipt and say, this exact receipt was for this exact event. So it's actually a little bit easier. Yeah. Passes are a little more difficult because now you've got like a blanket amount. And then I would actually say, okay, use the number of trips divided by the number of trips in a month, right? If you have a day job, you're doing 40 trips a month to your day job, and then let's say, the extra 6 were 3 different weekends when you had to go do something for your art. Okay, 6 out of 40, that's how much I'm running on. Do it that way.
So
Yes.
on the Presto card, and when you charge your card, you get a receipt.
Mm-hmm.
Would that be?
No, because you don't know that you're going to use that entire fee for your business, right? You're using it for personal too, right? If I put $40 on my Presto, how much of that was for this, right? I have to know. Now, a way you can handle it if it matters enough to you, like either you keep notes, or another way to do it is have 2 cards. One is your I'm going on a business trip card, and one is your personal use card. And then just write off the business use card. Because then you've got it clear. Which is also something you can do with credit cards. If you have 2 credit cards, to just decide that one is going to be all for your business and one is going to be all for your personal use, which has 2 advantages. One is for your own personal records, it's easier because you know that all your business stuff is on one statement. And the other thing is that you can actually write off the interest. If you carry a balance on a credit card, you can write off the interest as a business expense. But if you're combining your business and your personal expenses, then how much of that interest is for business? You don't know. If you have 2 separate cards, it's clear. The interest on this card is for business and the interest on this card is not. So that's another way, just separation.
So when you say that a written note would work, and you write down, I use the Presto card 10 times to commute from this place to produce this product.
Right,
That
yeah,
would be,
exactly. Don't use the word commute though. Commutes are not deductible. You have to say, you can go on a business trip, like, or a business expedition of some sort, but commute, I hate this term. Commute basically means if you go back and forth from your home to a regular place where you work, even if it's self-employment, that is not deductible. If it's sort of an unusual place, or if it's a moving target, that is deductible. That can be a really great area, and I'm not going to go any further into it because, frankly, I don't feel it's well defined by CRA. But that's, just so you know, that is their principle. Commuting back and forth to do a job. If it's like this desk, you have to be in this desk doing this thing, even though you're self-employed, they don't like that because regular people with regular jobs don't get to write that off. But if your business is sending you here and there and it's sort of all over the place and it's random or it's a one-off, those are deductible. But yeah, that's exactly what I would do. It's like, this day, I had to go to the AGO, so, you know, it's a $20 Presto fee right there, and I'm just gonna say that I spent it. Right? But have the date, you know, the date, where you went, and why. Anything else on this? Oh, yeah. Record keeping, everybody has their own way of doing it, and it's a lot like fitness, where consistency is everything. So you want a system that you can consistently do. Think about what you like, think about what you like. If you are a great lover of spreadsheets, and if you are, you know it, then maybe you want like a great system where you like itemize everything, and you have a pull-down menu and sorry, that's fine if you love it, if you love it. If you don't love it, and again, I will come back to this, you didn't get into the creative arts because you love spreadsheets, although there is a painter who works in Excel. He just makes all his art in Excel. Do you make art in Excel?
No, I've seen that.
Yeah,
Yeah.
cool.
Yeah,
I don't even know
so-
how he did it, and I love Excel.
Yeah.
I'm one of those people. But you know, just throwing it all in a shoebox, that's actually fun. There's nothing wrong with that. Like just to make sure that you actually have the receipts. In the end, it's more important that you have receipts, even if you don't need them, than that you don't have receipts. So if the best you can do is once a week or once a month, you take out your wallet, you dump out your purse, and you find all the receipts that are for business, because right now you still remember, right? And you throw it into a shoebox and just don't deal with it until the end of the year. There's nothing wrong with that. I ran my own business like that. That picture of the shoebox, the 2 slides ago, that was my shoebox. Not really. But it didn't look that different. And that's fine. It's fine. You know, don't feel like you need to like get QuickBooks or Simply Accounting or, you know, you don't have to get complicated about it. In the end, as a self-employed person who's not incorporated, all you really need to do at the end of the year is take your receipts, put them in different categories. This one is for cabs. This one is for materials, whatever. Put them in little piles and add up the piles and put a sticky on top and staple it all together and photocopy your thermals. And that's all you really need to do. So it's fine if all you want to do is like empty your pockets, spend 2 minutes emptying your pockets once a week, that's fine. Okay, and now we're at the open-ended part of this performance here. Let's see what time is it. Let's take a look. Here we are. It's 11:11. So we've got a bit of time. If anybody has some questions that they feel I didn't answer, or they'd like me to go into further detail. Anybody? Yes.
So we register for HST, the HST number. Do you have to register a business?
You do not.
You do not.
Registering a business, and people use that name too short. It's too short. And it gets confusing because register a business number is what you got when you opened your GST account. When you open your GST account, what you perceive is that you ask for an account, you got one. But actually 2 steps happen there. First, they give you a business number, and then they opened a GST account under it. So that is already registered. When people say registering a business, what they're usually talking about is registering a business name. Okay. So registering a business name, it's different. You don't do it through CRA, you do it through, here in Ontario, you do it through the Ministry of Finance, or Ontario Online, or whatever they're calling themselves this year. And what registering a business name does is it associates a name to you, and then you can take, you end up with like a document called a master business license with who you are and your business name. You can now take that to the bank and open a bank account under that name, meaning that you can take payments under that name. So if you, for example, you're doing a job but you want them to pay, Pete's Projects Inc., not Inc., sorry, that's incorporation, but Pete's Projects and not you personally, you'd have to register Pete's Project so that they can actually write you a check in that name. You have a bank account in that name.
Okay.
From the Canada Revenue Agency's point of view, registering a business name has no meaning. They don't care at all. HST is something completely different. And I really want to stress that. The second you start making freelance income, the second you bill anybody for anything, you're self-employed. There is no other paperwork you need to file to make you legit. You're legit. You know, business name is about bank accounts, HST is about HST, but you're already a business the second you start making some money. Okay. Yes?
When, let's say you receive a grant, a project grant, and you're dedicating the space in your home, in your apartment, to produce this particular project, how do you deduct that from the rent?
So this would be part of business use of home. Now, to begin with, if you are self-employed, generally, if you don't rent office space, your office is considered to be an office in your home. So almost immediately, you can write off a certain amount of business use of home. And the math behind it is similar to the vehicle. You write off the rent, the utilities, the insurance. You take a big number, and then you take a percentage of that number to write off as a business expense. So you have the cost of your domicile, the cost of keeping a roof over your head, and then you say, okay, my home office takes up 10 or 15 or 20 or 25% of my home, kind of depends on the size of the home, and you apply that percentage. It's supposed to be based on square footage or number of rooms, so 1 room out of 5, or 20% of the floor space, or 25% of the floor space. You apply that percentage to the big number of keeping that roof over your head, and that is what you get to write off. In a year where you're doing a big project, so now, like maybe your office takes up 15% of your home, but now the project is taking up an additional 15%. So in that year, you could do 30% of the whole home. However, unless you want the math to get complicated and unless you want it to get sort of less powerful for you, this is space that is dedicated to work. So it can't be a space that later in the day reverts to, like if you put it on your dining room table, you can't write off the area of your dining room for the whole year if at night you sweep it all off there to eat there. At that point, you would actually have to prorate and say, okay, it's 50% of the dining room because only 50% of the time is it for business and the rest of the time it's personal. So it starts to get kind of complicated if you move things in and out. So you're really trying to envision one area that's permanently 24 hours a day. You don't do anything there except work. And that's what you get to write off as business use of home.
And do you, when you write down that letter, it's just like a separate letter where you specify?
A letter?
How do you do that?
On the form, T2125 is where your self-employment is calculated. There's a whole list of expenses, including things like rent and property tax. Ignore those. Those are for if you rent studio space or an outside office. Further down is a section called business use of home, where there's room for all kinds of expenses that go to keeping a roof over your head. Then there's a total, and then there's a percentage use for business, or percentage use for personal that gets deducted, and what's left. And the reason that it's on its own, and the reason it matters, do not put your rent on the rent line. First of all, because then the rent is the whole rent, and it's supposed to be a portion. Second of all, there are special rules around business use of home. Business use of home can be deducted until it brings your income to zero, but no further. So let's say you're running a business where your only real expense is your home office. So let's say that in the whole year, you managed to invoice $1,000, but it cost, your business use of home calculation shows that the business use of home expense was $2,000. 1,000 in minus 2,000 is negative 1,000, right? Which is good for your taxes, but that's not what's going to happen here. What's going to happen is 1,000 in minus the first 1,000 of your business use of home brings your income down to zero. The rest of your business use of home expense that would have brought you into a negative number cannot be used this year. Instead, it gets carried forward to next year. So you're not allowed to use it to take a loss. And because of that, there's an additional calculation in how business use of home is treated. Everything else is deducted first, and then whatever is left, if that number is smaller than your business use of home, it's just going to bring you to zero, and the rest is going to get carried forward. So it's important to put it in the right place. When it comes to business expenses, there are certain expenses that have special rules, and so you have to treat them properly. Meals and entertainment, this is all in my booklet, by the way, my deductions booklet, so again, don't worry about not understanding all of this right now, but meals and entertainment, business use of home, capital assets, and vehicle are all treated a little bit differently from all other possible expenses. And so you have to make sure that you've entered that data correctly, or it won't calculate properly. Anything else? Yes.
What about business insurance?
Business insurance, there's a line called insurance.
Oh, okay.
Yeah, so it's right there. What kind of business insurance?
It's like professional business.
Like against getting sued?
Yeah.
Okay,
It's
yep, liability insurance,
Yeah.
sure, there's a section for it.
Okay.
Yes.
I was wondering, like, if you juggle some employment with
And you
a
do.
regular income,
Yeah.
and setting aside money for that in that case, and
Same deal. Take your 15 to 25% of your freelance income and set it aside.
and if you
You might not need all of that, but it's good to do.
if you make less than 30,000, do you even need to submit that?
Of course you do.
Okay, yeah.
As a resident of Canada for tax purposes, which is not the same as immigration purposes, if you're living here and working here, you're a resident for tax purposes, you must declare on your income tax return and pay tax on all worldwide income. Only. And the only thing is that when you're self-employed, it's just the profit portion, it's not the gross. So you definitely, yeah. The $30,000 mark is only, it's what they call the small supplier threshold. That if you're, like, everybody in business is a supplier. And if you're a small supplier, you're small enough that they don't really care that they're not getting HST for you, right? So it's okay if you don't collect it. They feel like, you know what, the administrative costs of just having you on the rolls is probably going to cancel it. They don't really care. Above 30,000, now you're a big enough deal that they feel like they're having a net loss here that if you don't collect your HST. That's what the 30,000 is about.
And does that deadline still apply? Like, is that extended even if you still have like the
Of course. If you have any freelance income at all,
You can still.
you have to get the after 6 weeks, and so does your partner.
Okay.
Yeah. I wouldn't say, that in a year when you don't have self-employment and you're, for whatever reason, really busy and you don't get your taxes filed on by April 30th, even though you're supposed to, I wouldn't say that you should just throw $100 in your self-employment because that gives you an extra 6 weeks to file and you only have to pay $30 in tax on that. I wouldn't say to do that. CRA won't care, they get $30 out of you. They're happy. But I wouldn't say that, don't do that. Anyway, anything else? Any other questions that are burning a hole in anybody's?
So for these deadlines, it's like, what is the calendar year?
The calendar year for all tax returns in Canada is January to December. There are countries that are different. Australia, New Zealand, their calendar, their tax year actually goes to, I think, either April 1st or April 30th or March 31st or something. But we are all on the calendar year, except for corporations, they get their own. So, okay. All right then. Well, so here's the deal. For those of you who are not here, too bad. For those of you who are, there are some postcards up there. The postcards give you sort of 5 tips on staying out of trouble with CRA, which is, of course, my primary purpose here, to keep you out of trouble. Also, they're good for 10% off of tax preparation if you decide to go with me. And, I am based in Toronto, but we do mail-in returns, and now we're actually putting, for obvious reasons, we were putting an extra emphasis on the mail-in remote return right now, so that people have the option, wherever they are, of not coming in because of the way things are right now. And certainly, we've always been able to do it, but now it's like become extra important. So there's nothing unusual about doing everything remotely. We are living in an age when that is very easy. You'll scan everything, or you'll take pictures with your phone or whatever, get that into us. We can do your returns. The other thing is a second reminder that if you sign up, you will get my tax tips, which you can unsubscribe if you want, but you'll also get access to that deductions workbook, the deductions guide, the HST guide, and a whole bunch of other sort of resources that I've written and made available up there. Also, if you have any questions or specific questions, I've actually thrown a lot at you, and even if you feel like you pretty much absorbed it, I guarantee you that a lot of it will disappear the second you walk through a doorway. If you still want to know more, you can always email us, or you can even, if you have a question that's specific to your business that is, a little more complex or requires a bit of back and forth, I do free phone consultations. So you'll just basically get in touch with us, taxes@personaltaxadvisors.ca, advisors with an ORS. Get in touch, say you need to discuss something, let us know what it's about. If we can answer it on the spot, we will. If we can't, we'll set you up with a phone conversation, we can have a conversation. And, you know, because I don't want any of you to feel like what you don't retain is gone. I'm around. That's what the modern era is for. So yeah, so I hope that this has really helped you mainly keep the exact right amount of anxiety around taxes. Like enough that you do file things, but not so much that you feel overwhelmed. It's my belief right now that being overwhelmed is like the worst state you could be in, because you just can't act. Handling your taxes should never be overwhelming. It's a shoebox, it's an afternoon with some receipts. It should not be overwhelming. But feeling that it's overwhelming to the point where you don't do it, now that, the 100% garnishee and the being evicted, that is overwhelming. So it's not that hard to keep it sort of just at the right level of awareness, you know? All right. Thank you so much for having me, and I really appreciate it. Okay, I'm gonna walk over here.
Yeah.
Is it over?
Yes.